Have you ever wondered how traders can bet on a stock going up without ever actually buying a single share? Well, today we're pulling back the curtain on a powerful tool they use called call options. I'm going to break down exactly how they work, the incredible potential for big gains, and, of course, the risks you absolutely need to understand. All right, let's get into it. So let's start with the big question that gets right to the heart of it all. How can you possibly profit from a stock you think is about to take off without shelling out thousands of dollars to buy it? This is the exact puzzle that call options were built to solve. They give you a way to get in on the action with way less money on the line. So what is a call option really? At its core, it's just a contract. That's it. It's basically a deal that gives you, the buyer, the right to purchase a stock at a specific price for a specific amount of time. And the key phrase to lock into your brain is right, but not the obligation. What that means is you don't have to buy the stock if things go sideways. You can just let the deal expire and walk away. Okay, that's the textbook definition, but let's be real. The best way to actually get this is to see it in action. So let's pretend we're feeling really good about Yelp stock. We think the price is going to go up soon, and we're going to use a call option to place a bet on that hunch. Here are the terms of our deal. Right now, Yelp is trading at around $36 a share. We're buying a contract that gives us the right to buy it at $38 a share. That's what we call the strike price. We've got 30 days to decide if we want to use this right, which is the expiration date. And for this whole privilege, we pay a small fee called the premium of 80 cents per share. So let's imagine the absolute best case scenario. You were right. In the next month, some fantastic news drops, and boom, Yelp stock shoots up to $42 a share. This is exactly what you were betting on. Suddenly, that little contract you bought is looking really, really good. So how do we cash in? Well, you use your right, you exercise the option to buy 100 shares at your locked-in price of $38. Then you can immediately turn around and sell those same shares on the market for $42. That's a quick $4 profit per share. But wait, you have to subtract the 80 cents you paid for the contract in the first place. That leaves you with a net profit of $3.20 per share for a grand total of $320. But, it's not always sunshine and profits. It doesn't always work out so perfectly. Where the stock price ends up on that final expiration day is literally everything. So let's break down the 4 different ways this trade could actually end. Before we get into those scenarios, there's one number you absolutely have to burn into your brain: your break-even price. It's super simple to figure out. It's just the strike price, which was $38, plus the 80-cent premium you paid per share. So for you to make even 1 penny of profit, the stock has to end up above $38.80. That's your finish line. All right, scenario 1, total wipeout. Let's say Yelp's price actually drops to $30. Your contract gives you the right to buy at $38. Would you do it? Of course not. Why on earth would you pay $38 when you could just buy it on the market for $30? You wouldn't. The contract expires worthless and you lose the $80 you paid for it. Okay, what if the stock actually goes up, but only to, say, $37? You were kind of right about the direction, but it's still below your $38 strike price. So again, there's just no reason to use the option. The contract expires worthless, and you still lose your $80. Now, this is where it gets a little tricky. Let's say the price lands at $38.50. You can exercise your option. You can buy at $38 and immediately sell for $38.50, making 50 cents a share. But remember, you paid 80 cents for that right. So you're still in the red, a net loss of 30 cents per share or $30 total. You crossed the strike price, but you didn't make it to that crucial break-even point. And finally, scenario number 4. Payday. The stock finishes at $42, way above your $38.80 break-even point. This is where you make money. And here's the really cool part about a call option. Your potential profit is, in theory, unlimited. The higher that stock soars, the more cash you make. So, you're probably wondering, that initial $80 cost, where does that number even come from? Is it just random? Nope. It's based on a few key things, mostly the strike price you pick and how much time you're buying yourself. Let's take a quick look. Think of it like this. The easier the bet, the more it costs to place it. A contract with a $37 strike price is more expensive because, hey, the stock only needs to go up a buck to be in the money. A $39 strike price is cheaper because it's more of a long shot. The stock has a lot further to climb. Basically, a better deal is going to cost you more. And time works pretty much the same way. A 30-day contract is cheaper because the stock has less time to make a big move. But a contract that gives you 7 months for your prediction to come true, that's way more valuable because there's just a higher chance of a big price swing in all that time. And because it's more valuable, it costs a lot more. Okay, hang on. Before we wrap up, there is one super important detail that confuses almost everyone at first. Options are traded in contracts, and every single contract represents 100 shares of the stock. So when you see a price quoted at 80 cents, that's the price per share. You have to multiply it by 100 to get the actual cost of the contract, which in our example is $80. So, after all that, all these moving parts, the strike prices, the expirations, what's the one big idea you really need to take away from all this? Why do people even bother with options? It all comes down to one single powerful word: leverage. Think about it. For just $80, you control the potential gains on 100 shares of Yelp. To go out and buy those same shares would have cost you $3,600. Options let you control a huge amount of stock with a tiny bit of capital, and that can massively amplify your returns. But, and this is a big but, that leverage is a double-edged sword. Yes, it magnifies your gains, but it also means that if you're wrong, you can lose 100% of your investment. So the final question you really have to ask yourself is this: while the potential for a huge reward is exciting, can you actually afford the price of being wrong?